Today's video is about capital gains tax and how you can pay 0% tax in 2013. I still have a hard time convincing current and potential clients that your tax expense is a year-round game, not just something you look at in April of each year. Some think they can do some planning at the end of the year, which is smarter than most. But the truly savvy taxpayers minimize their taxes as part of their overall personal finances. And it's something that should be done all the time. For a majority of you, taxes are your largest expense. Yet we all fall into the trap of paying more attention to budgeting for groceries or for recreation. Penny wise, pound foolish. It's time you start paying less taxes and use that money for something else. This video will give you an example of something that you can start planning for now instead of at the end of the year. First off, that's not a misprint in the title of this video. You can actually qualify for a 0% tax rate on some or all of your long-term capital gains realized in 2013. This tax break was recently extended by the American Taxpayer Relief Act, and it isn't necessarily off limits to taxpayers who are doing just fine financially. The strategy here involves figuring out how much capital gain you might be able to fit under the thresholds. The 0% tax rate applies to taxpayers who end up in the 10% or 15% regular income tax bracket. For instance, you may qualify for preferential tax treatment if your business incurs a loss this year, or if you defer a substantial amount of income to future years. Another idea, you might also switch some of your capital gain assets to your children or grandchildren who are eligible for the 0% tax rate. Now that's really crafty, but it's perfectly legal. Now this type of strategy involves very careful planning that should be started in the beginning of the year, not the middle of the year or the end of the year. You can easily back yourself into a corner if you don't implement this strategy properly. There are ways to limit your ordinary income year to year if you plan carefully. But each day that passes in the 365-day year decreases your chances of being able to do that. Now, single filers with taxable income above $400,000 and joint filers above $450,000 will pay a 20% rate on their long-term capital gains. If there is no way for you to get your income below that level, and we can talk about that to make sure that is the case, then this strategy may not work for you. But other strategies might. For example, something such as a federal land conservation easement tax credit. Things like that can reduce your taxable income by up to 50%. That's just an example of something you can do. Another example. Let's say you are self-employed. You're a joint filer and normally in the 33% tax bracket. However, due to unusual circumstances or certain other changes to your accounting methods or other good planning techniques, in 2013, you only expect your self-employment income to be $50,000. Plus you work with Credo and figure out how to cut your taxable income $20,000 through other types of deductions. This will give you plenty of room to maneuver on sales of securities or other assets. Let's say you sell appreciated stock you've owned for 10 years at a $50,000 gain. Because your total taxable income of $70,000 is still below the cutoff of $72,500, your entire long-term capital gain is effectively tax-free. That's enough tax savings to install that top of the line home theater, or the new kitchen your wife's been wanting or been dreaming about. Please note that it doesn't have to be an all or nothing proposition. For instance, say that your taxable income before counting capital gains is $52,500 instead of $20,000. In that case, $20,000 of the gains from the sales qualify for the 0% rate, and the remaining $30,000 is taxed at the 15% rate, a total tax of $4,500. So it's still a great deal. You're still paying a very low rate of income tax. One last thing to remember is that the 0% capital gain rate only applies to assets held longer than 1 year. They have to be long-term. Short-term gains are still taxed at ordinary income tax rates. In other words, at ridiculously high rates. This makes holding your investments for at least a year a significant advantage in mitigating your tax expenses. And your return on the investment after the net effect of taxes will be much, much higher. Now, I hope after this video you can see why these more lucrative tax strategies require very careful planning.